There is a country paying 12% interest right now, not a crypto platform, not a risky startup bond, a central bank, a sovereign interest rate, and almost no one in the everyday investing world is paying attention. This week, Colombia's Banco de la República raised its benchmark rate by 75 basis points. That pushed the official rate to 12%. For context, the U.S. Federal Reserve is holding rates steady. Fed Chair Kevin Warsh reiterated patience at the ECB forum this week. No commitment to cuts, no commitment to hikes, just watching. Meanwhile, Colombia went the other direction entirely. And buried inside that decision is a story about risk, opportunity, and global diversification that most portfolios have never once considered. Let's start with the obvious question. Why would a country raise rates to 12%? The answer comes down to three things: inflation above target, elevated inflation expectations, and a labor market that is still running tight. Sound familiar? It should, because those are the exact same pressures the Fed has been navigating for 2 years. The difference is Colombia acted decisively this week, 75 basis points in a single move. That is not a small adjustment, that is a signal. The central bank is telling the market, we are serious about getting inflation under control. And here is what that kind of signal does to bonds. When a central bank raises rates aggressively, local bond prices adjust immediately, but yields go up. And higher yields mean better income for investors who buy those bonds going forward. That is the mechanical reality most people skip past. Now here is where it gets genuinely interesting. The vote was divided. 4 board members supported the 75 basis point hike, 2 board members wanted a rate cut, 1 member preferred no change at all. Think about that for a moment. The same institution, the same data, completely different conclusions. That division tells you the policy outlook is uncertain, and uncertainty in bond markets creates pricing inefficiency. Pricing inefficiency is where opportunity lives. When a market is uncertain, prices move in ways that do not always reflect underlying value. That gap between perception and reality is exactly what long-term investors look for. But wait, there is more happening in Colombia this week than just a rate decision. The political backdrop shifted significantly. President-elect Abelardo de la Espriella named Miguel Gomez Martinez as finance minister. That name matters to markets. It signals a more market-friendly policy direction from the incoming administration. The new government is expected to focus on fiscal consolidation. That means spending restraint, a review of public investment projects, and potential tax changes designed to support investment and growth. Markets reacted in a measured but cautiously positive way. Investors were encouraged by the fiscal discipline signal, but cautious about implementation risk. Because here's the problem. Colombia's Congress is polarized. Passing major fiscal reforms through a divided legislature is genuinely hard, and the fiscal challenge itself is significant. Colombia's finance ministry recently revised its 2026 deficit target to 5.3% of GDP. That is a large deficit for an emerging market economy. It means the government is spending more than it collects. And to fund that gap, it will likely need to issue more government bonds. More bond issuance typically pushes yields higher, which circles back to the income opportunity. If you are finding this useful, consider subscribing for more practical financial insights. Now let's connect this to the bigger picture. This week, analysts at Edward Jones confirmed something that changes how you think about all of this. They said equities are expected to continue outperforming bonds broadly. Their preference is U.S. large caps, U.S. mid caps, industrials, and communication services. But they also said something specific about emerging markets. They remain overweight emerging market stocks. The reason? Emerging market equities could offer 50% or more earnings growth this year. That is not a rounding error. That is a structural story. And Colombia sits inside that story. So now you have a country with a 12% central bank rate, a new finance minister signaling fiscal discipline, a dividend of uncertainty that is creating bond pricing inefficiency, and a broader emerging market earnings picture that professional money managers are actively overweighting. Most everyday investors hear Colombia and think instability. They think unfamiliar. They think too complicated. But here's the thing about unfamiliarity. It is the source of pricing gaps. And pricing gaps are where returns actually come from. If everyone already understood the opportunity, it would already be priced in. The fact that most retail portfolios have zero Colombian exposure is part of why the opportunity exists. Now let's be honest about the risks here. This is not a simple trade. Currency risk is real. The Colombian peso is volatile. A strong US dollar can erode your returns even if the bonds perform well locally. Political execution risk is real. The incoming administration's fiscal promises need Congress to cooperate, and that is not guaranteed. Inflation risk is real. If inflation stays elevated, the central bank may need to go even further. That could create short-term pain in existing bond positions. So what does this actually mean for an everyday investor? A few things. First, if you hold a broad emerging market ETF, you likely have some Colombian exposure already. Check the holdings. Understand what you actually own. Second, the divided vote at Colombia's central bank is a signal to watch, not act on immediately. When policy committees are divided, the next move can go either way. Patience is a genuine strategy here. Third, the 50% plus emerging market earnings growth projection from Edward Jones is not evenly distributed. Some countries benefit more than others. Colombia's rate environment and fiscal pivot make it one of the more interesting case studies right now. Fourth, the broader lesson this week is about geographic diversification. Most everyday investors in the US or Europe are heavily weighted toward domestic assets. That felt safe for a long time. But when your home market is holding rates steady and watching data, a 12% sovereign rate somewhere else starts to look very different. It is not about chasing yield blindly, it is about understanding where the global rate cycle actually is. And right now, the global rate cycle is not moving in one direction. Japan is raising rates due to energy inflation and a massive fiscal spending plan. Colombia raised this week. The Fed is holding. Europe is navigating its own pressures. These are not the same market. They are four different financial environments happening simultaneously, and your portfolio should reflect that reality. The people who treat global markets as one single entity tend to make the same error repeatedly. They assume what works at home works everywhere. They assume the same risks apply everywhere. They assume the same timeline applies everywhere. None of those assumptions hold up right now. Colombia raising rates to 12% while the Fed holds steady is a perfect illustration of why those assumptions break down. And that breakdown is exactly where global investors who pay attention find the most interesting opportunities. The market is bigger than any one country. That is what this week's news is really telling us. Drop your thoughts below. What part of the global economy are you watching most closely right now?